Above the day-to-day left-right politics is qualitative listening. Hello, America. I'm Camille Chandler, and this is Qualitative Listening. Today's episode will be about ceasefire hurts long-term yields and Fed policy signals hurt short-term yields. But first, let's go over the bond market. The 3-month is at 4.3%. The 6-month is at 4.26%. The 2-year is at 3.81%. The 5-year is at 3.85%. The popular 10-year is at 4.3%. And the 30-year is at 4.84%. So the yield curve is still inverted in the short to mid-term, reflecting market bets on Fed rate cuts, while longer yields remain elevated as investors weigh inflation, fiscal risk, and global dynamics. The recent ceasefire in the Middle East led to a slight dip in long yields, including the 10-year, as investors moved into treasuries. Meanwhile, Fed policy signals, notably dovish cues from some officials, have also contributed to downward pressure on short and intermediate term yield. Let's break down each one. Why did the ceasefire lead to a dip in long-term yields? Number one, reduced geopolitical risk equals lower risk premium. When geopolitical tensions are high, investors fear escalation, supply chain disruption, or energy shocks, so they flee to safety, often buying U.S. treasuries, especially long-term ones. A ceasefire reduces that risk, lowers demand for treasuries slightly, but more importantly, reduces the embedded risk premium in long-term bonds. This pulls yields down as risk subsidies. 2. Lower oil price expectations. War in the Middle East usually raises oil prices, which can stoke inflation. A ceasefire eases fears of disruption in oil supply routes, so oil prices drop. Lower oil prices equals future lower inflation expectations. Investors demand less compensation for inflation, so long-term yields fall. So that's why ceasefire hurt long-term yields. Basically, the need for safety no longer applied. Now, let's break down why the Fed policy signals hurt short-term yields. When the Fed signals it's considering rate cuts, markets react by pricing in those future lower rates. Short-term treasury yields like the 3-month, the 6-month, and the 1-year are very sensitive to the Fed's target range. If the Fed is expected to lower rates, investors demand lower yields on short-term bonds because they know future rates will drop too. Think of it like this. If the Fed says we're cutting soon, then earning 5% for 6 months becomes a premium deal, so demand for those short-term bonds rise and yields fall. 2. Market front-runs the Fed. Investors don't wait for the actual rate cut. They anticipate it and start moving accordingly. As buying demand surges for short-term bonds to lock in high current yields, prices go up and bond yields go down. Fed tools directly target short-term rates. The Fed operates by setting the federal funds rate, overnight banking lending rate, usually open market operations like reverse repos and T-bill purchases, all of which affect short-term borrowing and lending costs directly. So when the Fed pivots dovish, money markets yield fall, 3 to 12-month treasury yields drop fastest. Alright, that's the show, folks. Thanks for listening to Qualitative Listening.